नरघट तक है तेरी कहानी, पग पग प्यारे। दंगल 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 दंगल, सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे। दंगल 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 दंगल।
Great morning, my dear friends. Bhupesh, Anand again, lecture number 4. So today we'll be starting with a very small learning outcome D. That is, what are the secondary markets? We have to describe the secondary market for bonds. It means what is the mechanism, what is the process of fixed income securities, bonds. If we talk from secondary markets point of view, we have discussed primary market, now we are discussing secondary market. Please firstly take out your registers, then only I will be starting with my explanation, because I have to give you very important explanation today. And 1 minute, if you are not putting the attention, next 5 minutes, the whole lecture will be lost. So take out your registers, write down great morning, lecture number 4, learning outcome number D, describe secondary markets for bonds. So I will be telling you what is the meaning of secondary market. We have already discussed in equity that there are two types of market. One is primary market and second is secondary market. Similarly, in case of bonds also, one is primary market, which we have discussed, and second is secondary market. When the issue is already being issued for the first time, and when those bonds are being sold and purchased second and subsequent time, it means it is not the first time they are issuing, they are being sold and purchased. It is the subsequent sale, that market is named as secondary market. Firstly, the farmer is selling the goods first time to the wholesale commodity market, that is the primary market. And when that wholesale market is selling to vegetable vendors or to consumers or to direct users, that is a secondary market. Similarly, in case of vegetables, in case of gold market, in case of foreign currency, in case of bonds, in case of equity, there are two types of markets. One is primary market and second is secondary market. Now, secondary market is for subsequent sale. In this learning outcome, I will be putting emphasis in discussing the mechanism or the process of secondary market. Please take out your registers and please write on first point, only first point, do not write on second point. First point is secondary markets refers to the trading of previously issued bonds. Secondary market refers to the trading of previously issued bonds. It means those bonds which have already been issued in the past. Now they are being traded again. That is named as a secondary market. And in USA or maximum in case of fixed income securities or in bond market, these are either over the counter markets or these are dealer markets. Either it means bonds in secondary markets, in the majority cases, they are not being through the help of exchange. Rather, it is a case of OTC, over the counter, or through dealer markets. Majority of the transactions of bonds in fixed or fixed income, they are done through dealer markets or over the counter market. It means dealer gives the quote. It means there are two types of quotes: order driven markets or quote driven markets. I repeat, order driven markets, quote driven markets. I'm telling, in this we will be telling you about quote driven. Now, what is the meaning of a quote? Who gives a quote? It means in case of dealer market, the quote is being given by the dealer. So write down point number 3. In USA, the markets of these bonds are quote driven exchanges. In USA, the markets of the bonds are quote driven exchanges. That is, quotes are given by dealers. And when I say quote is given by a dealer, for example, if you want to buy a foreign currency, you can go in a bank and bank gives a quote for a foreign currency, and it is composed of two quotes. One is named as bid rate and second is named as ask rate. Bid means buying rate, ask means selling rate. It means similarly in case of gold market, if you want to buy gold, there is a separate rate, and if you want to sell the gold to the same person, PP jeweler, that will be a separate rate. Similarly, in case of quote market and bonds, there are two quotes which are given by these dealers. One is named as bid rate and second is named as ask rate. One is buying rate. It means the rate at which that dealer will be agreeing to buy. The rate at which that dealer will agree to buy, That is named as buying rate, bid rate, and the rate at which dealer will be selling to you, because these rates are quoted by dealer. So we have to read it from the point of view of dealer. It is a dealer who is buying and it is a dealer who is selling, and these quotes are given by the dealer only. And the most important point is that buying rate is always, less than selling rate. It is but intuitive, and it is but logical that he will be selling at a higher rate, the same bond, as compared to the price at which he will be buying it. And the difference between buying rate and selling rate is named as spread, utterly, butterly, Amul spread. The difference between ask price and bid price is named as spread. Now wider the spread, it means this type of security has a lower incidence of liquidity. It is but natural and intuitive. And if that bond is highly liquid, if that bond is highly saleable, so in those types of bonds, I will say those bonds are liquidity is very high level of liquidity is there, because the spread will be narrower. So I repeat, the spread will be narrower. So you have written this fourth point, right? On fifth point, spread is the difference between bid and ask, and spread is narrower for liquid issues. It is but intuitive that if the difference between bid price and ask price is very less, it means spread is less. It means this asset is more liquid. And if the difference is wider between bid and ask, it means that asset is less liquid. And even I have given you the example for that. I have given a quote given by a dealer for bond A and bond B. 99 slash 99.10. 99 is the bid rate, 99.10 is the ask rate, and the spread is 0.10. In case of bond B, 99 slash 99.80, 99 is bid rate and 99.80 is the ask rate, and the spread is 0.80. So now in this case, the spread is more in case of bond B. So with the help of this feature, I can tell that bond B is less liquid as compared to bond A. So last point of today's lecture, and that is mechanism of, in secondary markets in bond. So for bond, the trade settlement, how the trade is settled, because it is a quote-driven market. So in case of a corporate bonds, we generally take 3 days after the trade. In case of a government bond, we generally take a 1 day after the trade. And in case of money market, the trade is being done same day. So please write down 7 point. Trade settlement is typically 3 days after. I repeat, 3 days after. 3 days after a trade for corporate bond, 1 day after a trade for government bonds, and same day settlement for money market instruments. So this you have to remember: same day for money market, 1 day for government bonds, and 3 days for corporate bonds. All is after that, after the date of trade. Hope you have enjoyed this lecture. Let's see Google Baba, what Google Baba is saying to us regarding code-driven markets. What is a code-driven market? A code-driven market is an electronic exchange system in which prices are determined from bid and ask quotations made by market makers, dealers, or specialists. It means these quotes are being given by the dealers. In a quote-driven market, also known as a price-driven market, dealers will fill order at this. It means there is a difference between quote-driven and order-driven. Just they have given the difference: order-driven markets and quote-driven markets. Now the point is, when I say order driven, it means it depends upon the order, and it is not necessary that that order will be filled up. But in code driven, it is necessary that that order will be filled up, because it depends upon the code. So hope you have enjoyed this lecture. Learning outcome number D: be happy, be jolly, be cheerful.